It's Tuesday, 14th of April, 2026. Welcome back to your news update on Blip Brief, crisp but almost everything updated every market trading day. So, the Indian stock market is actively digesting a massive geopolitical shockwave this morning. Both the Nifty 50 and the BSE Sensex actually closed down by nearly 1%.
Yeah, and underneath those top-line figures, I mean, the mid-cap volatility was just wild today.
Yeah.
And viral infra engineers surged over 15%, and a tool auto was up over 11%.
Right, but then on the total flip side, you had JOD CNC automation plummeting by almost 15%. Even precious metals like gold and silver slid near 1%, completely failing to act as a safe haven.
Well, the macroeconomic trigger tearing through the market is coming straight from the Middle East. After ceasefire talks collapsed over the weekend, the U.S. administration basically initiated a naval blockade of Iranian ports in the Strait of Hormuz.
Which is a massive escalation.
Yeah. Oh, absolutely. And it sent an immediate shockwave through global supply chains. We watched global oil prices whipsaw violently. I mean, they initially crashed by over 13% on ceasefire hopes, but then aggressively surged right back up once the blockade news hit.
Right, and if you're tracking logistics, container freight costs in West Asia have surged by almost 400%.
Exactly. That is literally a five-fold increase since this conflict began.
But wait, let's unpack the actual market reaction here. I mean, the Strait of Hormuz is essentially the jugular vein of global energy. If the U.S. is blockading the Gulf, why didn't the Indian markets crash by more than a single percent today?
That's a great question.
Because early trading saw a 2% drop, but we somehow recovered half of that by the closing bell.
Right, so that intraday recovery really came down to a highly localized diplomatic carve-out. Behind the scenes, Iran's envoy assured special arrangements specifically for India, guaranteeing safe passage without tolls for our vessels navigating that region.
Oh, wow. So a direct diplomatic shield?
Exactly. And when that news broke, it fundamentally shifted the risk calculus in Mumbai. Short sellers suddenly realized India might be partially shielded from a total supply chain freeze.
So they had to scramble, right? I mean, they were forced into massive short covering, rushing to buy back shares to close out those bearish positions.
Yeah, that wave of panic buying is what artificially lifted the indices back up from their daily lows. It's a textbook example of how diplomacy moves markets. But look, even with safe passage, a 400% surge in freight costs is going to inevitably seep into the broader economy.
Which brings us straight to the domestic squeeze. I mean, we're importing inflation directly from the Gulf, but there is also a domestic inflation story brewing right in our own backyard.
Right, India's retail inflation has ticked up to 3.4% in March.
And that's being driven by the fuel shocks we just discussed, plus rising food prices. We're already seeing edible oil imports jump by 12% in March. On top of that, the IND just predicted a below-normal monsoon.
Which is the weakest we have seen in a decade, yeah.
Exactly. Now, e-way bills did jump 12% year over year, indicating strong underlying economic activity, but those threatening skies seem poised to stall that momentum. It's a double whammy for the RBI. It's like trying to put out a fire in your living room, but the city just cut the water pressure.
That is an excellent way to put it. The e-way bill data tells us the engine is running hot, but the fuel mixture is getting incredibly expensive. A weak monsoon directly threatens the domestic output of pulses and oil seeds.
So how does a weak monsoon specifically connect back to the inflation we are importing?
Well, since domestic yields drop, we have to import more edible oil to compensate. And remember that 400% surge in container costs.
Right, the logistics crisis.
Exactly. That means every single metric ton of edible oil we bring in is exponentially more expensive to transport. It hits consumers directly in the grocery aisle.
So that puts massive margin pressure on FMCG companies, right? Because they can't just pass on a 100% price hike to the average consumer.
No, they absolutely cannot. The Indian consumer base is far too price sensitive. If a bar of soap suddenly doubles in price, the demand just evaporates.
Right, so they're caught in a brutal squeeze between rising raw material costs and those skyrocketing global logistics costs.
Exactly, which means their profit margins take a severe hit.
And that provides the perfect lens to view corporate India right now. As we kick off earnings season, the financial sector is showing this fascinating divergence. Private lenders are projecting net profit growth of roughly 12% year over year.
Yeah, whereas public sector banks are expecting a sluggish expansion of barely 2%.
It's crazy. Public versus private banks right now look like a two-speed engine on the same highway. Meanwhile, ICICI Asset Management reported a year-over-year profit jump of over 10%, but a sequential drop of nearly 17%.
And let's not forget, LIC is rewarding shareholders with a 100% increase to its paid-up equity base via a one-for-one bonus share issue.
Right, boosting liquidity. Also, quickly on the corporate front, Burgess Godrej is taking over Godrej Aggregat, with Parosha Godrej taking the group helm later this year. And TCS is currently conducting an internal probe into a harassment case at its Nashik unit.
Which just shows corporate governance remains firmly in focus amidst all this.
Absolutely. But going back to the banks for a second, if credit growth is skyrocketing, shouldn't all banks be making a killing? Why the sluggish 2% for PSBs?
Because of the deposit squeeze. I mean, credit growth is heavily outpacing deposit mobilization right now.
Because consumers are putting their money into equity markets instead of savings accounts.
Exactly. So banks are desperate for capital. They're being forced to offer higher and higher deposit rates just to attract retail savings, which brutally crushes their net interest margins.
And the private banks are just slightly better positioned to weather this cost of funds storm than the PSBs.
Yeah, they use advanced data analytics and digital onboarding to secure sticky deposits much faster, whereas PSBs are constrained by legacy physical networks.
Right. And what about that sequential drop of nearly 17% for ICICI AMC?
That's just the broader market volatility. When markets face geopolitical shocks, retail investors pause their investments, which directly impacts that quarter-over-quarter revenue.
Makes perfect sense. Okay, let's shift gears entirely. We've been talking about corporate balance sheets, but I want to look at human health. The weight loss market is massive, and Stanford scientists just used AI to discover a natural Ozempic molecule.
Oh, this is a huge, huge technological leap.
Right. It mimics the powerful appetite-suppressing effects of those blockbuster weight loss drugs, but completely bypasses the unpleasant side effects.
Yeah, to understand how big this is,
Mhm.
you have to look at current GLP-1 drugs. They actually fail to work for roughly 10% of the population due to specific genetic variants.
And they carry sweeping side effects.
Exactly, because traditional drug discovery relies on broad-spectrum pharmaceuticals that often bind to unintended receptors, causing that collateral damage.
Right. So instead of using a sledgehammer that damages the whole body with side effects, AI acts like a safecracker. It listens to the clicks of the body's metabolism to find the exact combination.
I love that analogy.
Wow.
Yes, the AI maps the precise geometry of the target receptor and designs a bespoke molecule that binds exclusively to that specific pathway.
And it solves that 10% genetic failure rate by designing molecules tailored for specific biological pathways.
Exactly. It completely eliminates the trial and error phase. Science is moving away from broad-spectrum drugs to true precision medicine.
Which represents a multi-billion-dollar disruption to the current pharmaceutical landscape. It's absolutely fascinating.
It really is. It changes the entire paradigm of how we treat disease.
And just before you go, quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.